Hi there, it's Friday the 8th of March 2019. I'm Steve Towers. Welcome to ITB, coming to you today from Hong Kong. Let's get started. The French government has released its bill for the imposition of the digital services tax. I'll run through the key aspects, but there are no surprises. The tax will apply retrospectively from the 1st of January 2019. The tax rate is 3%. The tax base will be French source revenue from the three in-scope services: online advertising, sale of collected user data, and intermediation services. The amount of French source revenue will be calculated based on the proportion of French users versus total users. And for that purpose, the tax includes place of supply rules to enable French users to be identified. The tax will apply to resident and non-resident companies which satisfy both of the two threshold conditions: global revenue from the three in-scope services of 750 million euros, and French source revenue also from the three in-scope services of 25 million euros. The tax will be paid by 2 installments each year. However, for 2019, there will be only one instalment in October based on 2018 revenue. The tax paid will itself be deductible for corporate income tax purposes. For a copy of the bill, plus 2 briefing documents issued by the French government, please go to our website or app. Yes, or app. Our new ITB app is now available at the App Store and Google Play Store. The OECD public consultation on its 2 pillars, 4 proposals is in full swing. According to an OECD spokeswoman, over 100 written submissions have been made. The OECD has stated that it will make the submissions available on its website as soon as possible. And the public consultation meeting is scheduled for next Wednesday and Thursday. The OECD has indicated that the meeting will be streamed live. For the collection of written submissions and information about the live streaming, please go to our website or app. Australia and Indonesia have signed a free trade agreement called the Indonesia-Australia Comprehensive Economic Partnership Agreement. For information about this agreement, including a copy of the agreement itself, please go to our website or app. In China, the government has announced that the VAT rates of 16% and 10% will be reduced to 13% and 9% respectively. According to estimates, this will transfer 600 billion RMB, which is about 90 billion US dollars, from the government to the private sector. The effective date for the change has not been announced, but commentators expect that it will be in the next few months. After the change, China will probably have 3 VAT rates: 13%, 9%, and 6%. In Vietnam, the tax authorities have issued guidance in regard to the tax incentives for companies which perform R&D in the science and IT industries. The incentives include a 4-year income tax exemption, followed by a 50% income tax exemption for the subsequent 9 years. For a copy of the guidance, please go to our website or app. The European Court of Justice has decided a case on the compatibility of Germany's CFC rules for foreign passive income with the EU's free movement of capital. The case is called Ex GmbH, and it was decided by a Grand Chamber of 13 judges. And at the start, I should emphasise that this case concerns the EU's free movement of capital and not the EU's freedom of establishment, because the relevant CFC in this case was established in a third country, Switzerland, and not an EU member state. The case has two main issues. Firstly, are the German CFC rules covered by the so-called standstill provision in Article 64 of the TFEU? And secondly, if they are not, do those rules breach the free movement of capital in Article 63 of that treaty? Those two provisions are related. Article 63 relevantly says this: all restrictions on the movement of capital between member states and between member states and third countries shall be prohibited. And Article 64 relevantly says this: the provisions of Article 63 shall be without prejudice to the application to third countries of any restrictions which exist on the 31st of December 1993 under national law in respect of the movement of capital to or from third countries involving direct investment, including in real estate, establishment, the provision of financial services, or the admission of securities to capital markets. You'll notice that Article 64 refers to 4 specific situations involving the movement of capital to or from third countries: direct investment, including real estate, establishment, the provision of financial services, and the admission of securities to capital markets. Article 64 does not refer to the movement of capital to or from third countries involving portfolio investment. And so Article 64 permits the continuation of restrictions on the free movement of capital in regard to third countries which involve one of those 4 situations and which were in existence on the 31st of December 1993. The German CFC rules were in existence on that date. So the question for the court was this: have there been any post-1993 amendments to the German CFC rules which have caused a break of continuity? The court looked at 2 post-1993 amendments. The first was the reduction in the minimum shareholding for the application of the CFC rules. This was 10% on the 31st of December 1993, but was reduced to 1% some years later. A 10% shareholding is direct investment, but a 1% shareholding is portfolio investment. The court held that reduction has no impact on the continuity of the CFC rules. The relevant amendment, which lowered the shareholding threshold from 10% to 1% in the capital of the companies concerned, even though it may have resulted in the inclusion of investments other than direct investments within the scope of the German CFC rules cannot affect the fact that the member state concerned has the option of continuing to apply to third countries restrictions which existed under national law on the 31st of December 1993, on condition that those restrictions concern movements of capital that are the subject of Article 64. In other words, as regards the taxpayer in this case, which held a 30% shareholding in the Swiss company, a direct investment, the lowering of the shareholding threshold from 10% to 1% had no impact, and thus for that taxpayer, the post-1993 continuity has been maintained. The second post-1993 amendment was more difficult for the court to deal with. In the year 2000, substantial amendments were made to the German CFC rules. The amending legislation entered into force on the 1st of January 2001. However, those amendments were themselves repealed shortly thereafter, with the result that the original 31st of December 1993 position was then restored. But restoration of the original position is not good enough, according to the court. The application of Article 64 presupposes not only that the essential substantive content of the restriction at issue has been maintained, but that that restriction has also existed continuously. If there were no requirement that the restrictions permitted under the standstill clause in that article should form part of the legal order of the member state concerned continuously since the 31st of December 1993, a member state could, at any time, reintroduce restrictions on the movement of capital to or from third countries which existed as part of the national legal order on the 31st of December 1993 but had not been maintained. But that's not the final answer. The court said that it needs to be determined whether those amendments ever became applicable. If they were repealed before they became applicable, then continuity has been preserved. The court said this: however, notwithstanding the formal entry into force of the provisions repealing or amending the legislation laying down a restriction which existed on the 31st of December 1993, that restriction must be regarded as having been maintained continuously where the applicability of the repealing or modifying provisions is deferred under national law and those provisions are themselves repealed before they ever become applicable. In such a scenario, it must be held that such a restriction has remained part of the legal order of the member state concerned and has done so continuously. The court asked the referring court in Germany to make that determination. The second issue in the case concerns Article 63. Do the German CFC rules breach the free movement of capital in Article 63? The court concluded, yes, in principle, they do. The court said this: pursuant to the German CFC legislation, a taxable person who is resident for tax purposes in Germany and holds at least 1% of the shares in a company established in a third country with a low tax rate is to be allocated pro rata to the amount of the shareholding, the so-called passive income obtained by that company, irrespective of any distribution of the profits. By contrast, a taxable person holding an equivalent shareholding in a company established in Germany is not subject to that legislation, since it applies, by definition, only to cross-border situations. In those circumstances, the court must hold that the German CFC legislation is such as to discourage investors with unlimited tax liability in Germany from investing in companies established in certain third countries, and therefore constitutes a restriction on the free movement of capital, which is prohibited in principle by Article 63. In principle means that there were some other matters that the court needed to address. The most important of these was the question of whether this restriction on the free movement of capital was justified by an overriding reason in the public interest. The court said this: in their written observations, the German, French, and Swedish governments submit that legislation such as the German CFC legislation is capable of being justified by overriding reasons in the public interest, namely safeguarding the balanced allocation between member states and third countries of the power to impose taxes, preventing tax evasion and avoidance, and ensuring the effectiveness of fiscal supervision. The court accepted those arguments, but only to the extent that the German CFC legislation is designed specifically to prevent conduct that consists of creating wholly artificial arrangements. At that point in the decision, the reader starts to anticipate the application of the Cadbury-Schweppes principle. But no, the court expressly decided not to apply Cadbury-Schweppes in this case, because Cadbury-Schweppes concerns the freedom of establishment between EU member states, the so-called internal market, whereas this case concerns free movement of capital between a member state and a third country. The court said this: in the context of the free movement of capital, the concept of wholly artificial arrangement cannot necessarily be limited to merely the indications referred to in the court's 2006 decision in Cadbury-Schweppes that the establishment of a company does not reflect economic reality, since the artificial creation of the conditions required in order to escape taxation in a member state improperly or enjoy a tax advantage in that member state improperly can take several forms as regards cross-border movements of capital. Indeed, those Cadbury-Schweppes indications may also amount to evidence of the existence of a wholly artificial arrangement for the purpose of applying the rules on the free movement of capital, in particular when it proves necessary to assess the commercial justification of acquiring shares in a company that does not pursue any economic activities of its own. However, that concept is also capable of covering, in the context of the free movement of capital, any scheme which has as its primary objective or one of its primary objectives the artificial transfer of the profits made by way of activities carried out in the territory of a member state to third countries with a low tax rate. So, how does the German CFC legislation match up against this test? Not very well. The automatic nature of the German CFC legislation, comparable in essence to an irrebuttable presumption of tax evasion or avoidance, cannot be justified solely on the basis of the criteria established by that legislation. Although a low tax rate applicable to the income of a company established in a third country, or the passive nature of the activities which generated that income, as defined by that legislation, can constitute indications of conduct that might amount to tax evasion or avoidance, they are not, as such, sufficient grounds to find that the acquisition of shares in that company by a taxable person residing in a member state necessarily constitutes an artificial scheme in all cases. The German CFC legislation, in that it presumes that conduct is artificial on the sole ground that the conditions laid down by that legislation are met, while affording the taxable person concerned no opportunity to rebut that presumption, goes in principle beyond what is necessary in order to attain its objective. And you'll notice there's that phrase, in principle, again. The significance of that phrase relates to the fact that the German tax authorities might not be able to verify the taxpayer's explanation by accessing information in the third country, Switzerland in this case. And so the court concluded that the requirement that the German CFC legislation provide an opportunity for the taxpayer to give its commercial explanation of the structure applies only if Germany has the legal framework, such as treaties, with the third country to obtain the necessary information to verify the taxpayer's explanation. If Germany does not have that legal framework, then it is not necessary for the German CFC legislation to provide the taxpayer with the opportunity to give its commercial explanation. The court therefore asked the referring German court to determine whether Germany does have that legal framework with Switzerland. For a copy of this decision, please go to our website or app. The European Commission has opened an in-depth state aid investigation concerning the support by the governments of Denmark and Sweden in regard to the fixed link bridge between the two countries. You'll remember that the European General Court in September 2018 annulled the Commission's 2014 decision that the government's support was compatible with the EU state aid rules. The court did not determine whether the state aid rules were breached. For a copy of the Commission's press release on this matter, please go to our website or app. And the European Commission yesterday opened yet another in-depth state aid investigation. This one concerns tax rulings granted by Luxembourg to the Finnish food and drink packaging company Huhtamäki. The Commission says this in its press release. Huhtalux, a Luxembourg company in the Huhtamäki Group, carries out intra-group financing activities. It receives interest-free loans from another company in the Huhtamäki Group based in Ireland. These funds are then used by Huhtalux to finance other Huhtamäki Group companies through interest-bearing loans. The three tax rulings issued by Luxembourg allow Huhtalux to unilaterally deduct from its taxable base fictitious interest payments for the interest-free loans it receives. According to Luxembourg, these fictitious payments correspond to interest payments that an independent third party in the market would have demanded for the loans that Huhtalux receives. However, Huhtalux does not pay any such interest. These deductions reduce Huhtalux's taxable base and, as a result, the company is taxed on a substantially smaller profit. At this stage, the Commission has doubts that this tax treatment, as endorsed in the Luxembourg tax rulings, can be justified. The Commission is concerned that Luxembourg has accepted a unilateral downward adjustment of Hutulux's taxable base that may grant the company a selective advantage. This is because it would allow the group to pay less tax than other standalone or group companies whose transactions are priced in accordance with market terms. If confirmed, it would amount to illegal state aid. For a copy of the Commission's press release, please go to our website or app. In France, the bill to introduce the digital services tax also proposes an amendment to the corporate income tax rate for 2019. Under legislation passed in 2018, France will reduce its corporate income tax rate progressively from 33.33% in 2018 to 25% in 2022. As part of that program, the rate for 2019 was set at 31% for profits exceeding €500,000 and a lower rate of 28% for profits up to €500,000. The DST bill proposes to reinstate the 33.33% rate in 2019 for companies which have a turnover of €250 million or more, determined on a group basis. For such companies, the 33.33% rate will apply to their profits above €500,000, with the profits below $500,000 being subject to the 28% rate. In Luxembourg, the government has presented the 2019 budget. Only two items are worth noting. Firstly, the standard corporate income tax rate will be reduced from 18% to 17%. As a consequence, the combined corporate income tax rate, including the employment fund surcharge and the municipal business tax, for a company with its statutory seat in Luxembourg City will be 24.94% in 2019, down from 26.01% in 2018. And secondly, the ATAD interest deduction limitation rules will be amended to allow them to apply by election either to a fiscal unity or alternatively to the individual companies within the group. Also in Luxembourg, the tax authorities have released guidance in regard to the recognition of a PE in a foreign country. This has been a very topical issue in recent years due to the European Commission's state aid claim in regard to Luxembourg tax rulings issued to McDonald's. Under the guidance, a Luxembourg taxpayer which asserts that it has a PE in a country with which Luxembourg has a double tax treaty can be requested to provide confirmation that the foreign tax authorities consider the taxpayer to have a PE in that country under the definition in the treaty. If the treaty does not contain a provision which is equivalent to Article 23A(4) of the OECD Model Treaty, it will be mandatory for the taxpayer to provide such confirmation. For a copy of this guidance, please go to our website or app. In Sweden, the government has launched a public consultation in regard to a proposal to allow a deferral of dividend withholding tax on dividends paid to foreign legal entities in loss-making positions. The proposal is in response to the recent ECJ decision in the Safina case. The government has requested comments by the 11th of April. For a copy of the consultation document, please go to our website or app. In the UAE, the tax authorities have issued updated guidance on the VAT treatment of real estate transactions. For a copy of the updated guidance, please go to our website or app. In Argentina, the government has issued General Resolution 4428, which sets out the requirements for a mining company which benefits from the tax stability regime to request a refund for overpayments of tax. For a copy of the resolution, please go to our website or app. In Canada, the tax court has decided a case in regard to Canada's R&D expenditure-based tax incentive. The issue in the case was whether a company's expenditure totaling over 4 million Canadian dollars qualified as scientific research and experimental development expenditure under the Canadian tax legislation. The court held that some of it did and some of it did not. If you're involved in R&D expenditure-based tax incentives, you should read this case. You can find a copy on our website or app. In the US, the long-awaited proposed regulations on FDII have been released. The proposed regs provide guidance on the Section 250 deduction, which is relevant to both FDII and GILTI. So far, the reaction of commentators has been generally positive. If you would like to obtain a copy of the proposed regs, they're 177 pages. Please go to our website or app. Also in the US, the IRS Advanced Pricing and Mutual Agreement APMA program has announced that it has developed a functional cost diagnostic model to facilitate analysis in certain APA cases. As stated by the IRS in its news release, IRS officials have announced that the IRS's APMA program is making available for general reference an Excel workbook that APMA may request taxpayers to complete during the APA process in certain cases, typically representing a distinct minority of APMA's overall APA inventory, in which two or more controlled taxpayers make material, non-benchmarkable contributions to their intercompany arrangement. The calculations in the workbook allow a pro forma split of residual profits or losses to be derived. For a copy of the IRS's news release, which tells you how to get your copy of the workbook, please go to our website or app. And now for this week's treaty developments. We've had 3 treaties signed and 1 treaty enter into force. And in regard to the Chile-Norway treaty, the Norwegian government has released a letter which describes the impact of the latest triggering of the most favoured nation clause in that treaty. I say latest triggering because that MFN clause has been triggered before, in 2004 by the entry into force of the Chile-Spain treaty. Norway's letter focuses on the impact of the Chile-Japan treaty, which entered into force in 2017. For a copy of Norway's letter, please go to our website or app. I have two articles for you this week. The first article is called "The ECJ as a Protector of Tax Optimization via Holding Companies." It's written by Blažej Kuzniacki, please excuse my pronunciation, and it's published in the Intertax Journal. In this article, the author reviews 3 recent taxpayer-friendly income tax cases decided by the European Court of Justice in regard to holding companies with minimal activities. The first is the Echiom case, which was decided by the court in 2017 on referral from France. The second is the Deister Holding, Euler Holding joined cases, which were also decided by the court in 2017 on referral from Germany. And the third is the Hornbach-Baumarkt case, which was decided by the court in 2018 on referral from Germany. The Echiom case concerns French domestic law anti-avoidance rules, which were applied by the tax authorities to deny dividend withholding tax exemption under the EU Parent Subsidiary Directive in regard to a corporate group which was ultimately owned by a non-EU company. The court held that the domestic anti-avoidance rules breached both the Parent Subsidiary Directive and the EU Freedom of Establishment for the reason that they included a general presumption of abuse in a situation where the ultimate group ownership is outside the EU. The author writes this: "Under the ECJ's judgment, there is no place for general presumptions of abuse, which could lead to effectively shifting the burden of proof of abuse from the tax authorities to the taxpayer, as the French law did by inferring abuse from the fact that a company is controlled or owned by a non-resident company from a third state." The Deister Holding, Euler Holding joined cases have similar facts to Echiom, particularly the Euler Holding case. In both of these cases, the German tax authorities applied a domestic law anti-avoidance rule to deny the dividend withholding tax exemptions under the Parent Subsidiary Directive due to the upstream ownership of the dividend recipient company. And in both of the cases, the court held that such a general presumption of abuse breached both the Parent Subsidiary Directive and the EU Freedom of Establishment, just like in Echiom. The author makes an interesting comment on the court's decision in these 2 joined cases. The ECJ noted that the PSD does not contain any requirement as to the nature of the economic activity of companies falling within its scope, or the amount of turnover resulting from those companies' own economic activity. As a result, a non-resident parent company with economic activity consisting of the management of its subsidiaries' assets exclusively, and likewise deriving income only from such management, qualifies to be exempt from taxation under the PSD. Pure holding and management companies do not constitute wholly artificial arrangements which do not reflect economic reality. In this regard, the ECJ rejected the possibility to rely on its case law in VAT cases, according to which the pure management of assets or holding of shares does not constitute an economic activity. The third case, Hornbach-Baumarkt, is quite different. It concerns the German domestic law cross-border transfer pricing rules. those rules were applied by the German tax authorities to impute an arm's length guarantee fee to a German company which had provided a bank guarantee with no fee to its indirect Dutch subsidiaries, which were in severe financial difficulties. The court held that the unrestricted application of the arm's length principle can be a breach of the EU freedom of establishment. And in this case, the German company needs to be given an opportunity to provide the commercial reasons why it did not comply with the arm's length principle. The author notes this: of pivotal importance for holding companies is the very finding of the ECJ that a sole or significant shareholder of a foreign company or companies may effectively justify its non-arm's length terms of transaction with its subsidiaries due to its economic interest in their financial situation. If the situation is critical to the subsidiaries, for instance, their business activities may be ceased due to a lack of sufficient financing, then the parent company has a valid economic justification to appropriately support the subsidiaries, even though such support may deviate from market conditions between unrelated parties. The second article is called Brexit and NAFTA Demise Could Jeopardize US Treaty Benefits. It's written by Laurie Hellkamp and Courtney Robinson, and it's published in Tax Analyst's Worldwide Tax Daily. This article focuses on the looming problem of how to satisfy the derivative benefits test under the LOB article in US double tax treaties, in the context where both the UK leaves the EU and the North American Free Trade Agreement no longer exists because it is replaced by the USMCA. Actual amendment to the treaties is probably not an option. Senator Rand Paul in the US Senate for many years has obstructed the tax treaty ratification process. The authors write this: many companies rely on a derivative benefits provision to satisfy LOB and claim treaty benefits under US treaties. Once the United Kingdom leaves the EU and EEA, and NAFTA no longer exists, and we note that none of the US treaties contain express NAFTA successor language, taxpayers can presumably no longer rely on their shareholders' residence in those states to satisfy LOB under the derivative benefits provisions as written. Alternative means of satisfying LOB, including potentially petitioning the relevant competent authorities, should be investigated. An interesting aspect of this article is that it contains a list, apparently complete, of all of the in-force US double tax treaties which are impacted by this looming problem, 15 in total. The list also contains the citations to the relevant treaty provisions. Well, that's the way it is this Friday, the 8th of March, 2019. I'm Steve Towers in Hong Kong. Have a great weekend.